This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pachurdes. Thanks for joining us at XM.com. Investors are in for a stormy ride today as the latest U.S. employment report will be rolled out into a market that is deprived of liquidity. Many traders are away from their desks for the Good Friday holiday, and several markets will remain closed entirely, which can amplify any market reaction on the U.S. jobs data. Nonfarm payrolls are projected at 239,000 in March, while the unemployment rate is seen unchanged at 3.6%, remaining close to multi-decade lows. Wage growth is anticipated to have lost some steam in yearly terms, but nothing dramatic. It's difficult to provide a prognosis about any potential surprises in this data, as early labor market indicators flashed some mixed signals. With the markets currently pricing the prospect of a final Fed rate increase next month as a 50-50 coin toss, this payrolls report will be instrumental in shaping those expectations and deciding the dollar's fortunes. Since U.S. stock and bond markets will remain closed today, the FX arena will essentially be the only game in town, and the shortage of liquidity implies that any moves in the dollar in the wake of the employment numbers might be more ferocious than usual. Rising bets that the Fed will be forced to slash interest rates before year-end have ravaged the dollar lately, and the cheerful mood in equity markets as the banking panic receded didn't do the reserve currency any favors either. Still, it's difficult to be negative on the dollar. While the U.S. economic data pulse is slowing and the bond market is screaming a recession is on the horizon, that's not necessarily a death sentence for the dollar, as most major economies are arguably in worse shape. Even when a recession originates in America, it is quickly exported to the rest of the world, so there is no real refuge for investors. Gold prices have been on a tear this week, piercing above $2,000 with some momentum and managing to hold that region. Beyond speculation about Fed rate cuts, another driving force behind bullion's meteoric ascent has been the Chinese central bank, which raised its gold reserves for a fifth consecutive month in March. The fact that such a whale is lurking in the gold market is a great sign for bullion, especially if recession risks and rate cut bets remain in play. Finally, shares on Wall Street enjoyed a solid recovery yesterday after the latest round of U.S. initial jobless claims pointed to a labor market that is cooling, fueling speculation that the Fed is on the cusp of a pivot. This was today's Daily Market Comment. Thanks for joining us at XM.com.